And you'll see it's been an absolutely fantastic weekly performance. The VanEck crypto and blockchain innovators is now up 50% since we bought it. I'll repeat that. It's now up 50% since we bought it.
8 weeks ago.
I think what I said before, when we were talking about selling someone, it was 30% up. It's now 50% up.
All right, smart ass.
Just to push you there, would you want to be invested in emerging markets ex-China or emerging markets with China?
So when I look at things, there are two things I saw this week which make me go, I wonder.
Oh, hello. Tell me more. Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to episode 14 of The Art of Investing, brought to you by IG, the global investing platform. Now, difficult decisions to be made this week. Potential for the bulls and the bears to butt heads. But, as always, we will start with the Spice Market Update.
Thank you, Rich. Well, we're into the second week of a US government shutdown and markets are completely shrugging it off. New all-time highs pretty much everywhere, including the DAX. Woohoo!
That's brilliant
the
news.
laggard. That was last
brilliant.
night, so that's great. Even Bitcoin eked out a new all-time high.
Yes.
So all sorts of other assets are now beginning to catch up with the leaders that have been the US, and the FTSE again hitting new all-time high.
Sorry, were you saying the FTSE was a leader as well, though?
Yeah, this time. Albeit briefly.
New all-time high.
It was earlier this week, not now. Anyway, one of the other big news stories this week was in Japan. And one of the reasons the Nikkei hit a new all-time high, as we expected and we sort of speculated, Japan have had their first woman prime minister. Sanae Takanichi is coming to power. Remember, she said she was a bit of a Thatcherite, which a lot of people will sort of make their skin crawl on hearing that. But that's positive for stock markets. And she's pro-business, pro-stimulus, and supports increased public spending and easier monetary policy. And those are all things that help equity markets. And so the Nikkei hit a new all-time high this week. In fact, it's up about 4 or 5%, I think.
Wasn't great for the yen, though, was it?
No, but that still ironically helps the underlying stock market because a lot of Japanese companies are exporters. And when your currency falls, when you're manufacturing in that country, you better basically get a competitive advantage against a country where they have higher currency rates. And that's ironically one of the reasons UK exporters have benefited over a long period of time because the pound has tended to fall over a very long period of time. So there's swings and roundabouts.
And it's important also to think about that in terms of what Trump is up to as well. You know, Trump wants to ease off the dollar if he can, not too obviously, but just drive it down a little bit, which helps then the export performance of the US. So there's a lot of people who wouldn't mind their currencies coming off a little bit. And it's just a question of how quickly they do and how controlled that is.
I think that was called Race to the Bottom about 10 years ago, wasn't it?
Well, interestingly, actually, the dollar has had one of its best weeks in a very long time. It's up over 1% this week against a basket of other currencies like the euro, the Japanese yen, and the pound sterling. And part of the reason for that is obviously the yen has been weaker. And the other reason is because of the political turmoil in France, which has continued this week. We saw Sébastien Lecornu basically have to resign after he couldn't get a budget together. After just, get this, 26 to 27 days, I think he was in power.
I think that beats Liz Truss, doesn't it?
It does. Liz Truss made 49 days. So the French political turmoil is even worse than ours, and we'll see what they go. But there is some speculation there may be, a need for a snap election in France. But that, combined with the weaker yen and obviously a forthcoming budget in the UK, has led to a combination of those currencies being weaker, the dollar being stronger. Also, in America, Trump and his team have been busy at work buying yet more stakes in yet more companies. This time, they're chancing their arm a bit. They're actually buying a stake in a Canadian mining company called Trilogy Metals, and they basically are mainly a copper and zinc mine, but they also have some rare earths in amongst that. But their mine is actually based in Alaska. But nevertheless, the Department of Defense, who are basically driving all these deals because they're trying to secure security and sort of mineral security, if you like, for the longer term for America, has done this other deal. Remember, the last few weeks we've touched on many of them, and there is speculation there are many, many more to come. So that should be good for underlying valuations of mining companies, which I think we'll be talking about later on when we come to review what we might do with the portfolio or may not do with the portfolio this week. Obviously, there's also an interesting fact for those young'uns amongst us and those who follow sport, but Cristiano Ronaldo has become the first ever football billionaire this week because he signed a new contract with the Saudis, and he's now apparently his net worth has risen to $1.4 billion according to Bloomberg Intelligence, and that's on the back of him being a major star in EA Sports, which obviously got taken private last week for $55 billion, one of the largest ever leveraged buyouts in history.
It's in the game.
It's in the game. Another big move this week of a very big company was, again, AMD, or Advanced Micro Devices. And basically, they have agreed a deal to supply OpenAI, who own ChatGPT, with hundreds of thousands of AI chips going forward. And it added 40% to the AMD share price over the past few days. It's pretty incredible. All these circular deals that are going on, companies interfunding each other, is perhaps, a bit of a warning sign that it's getting a bit silly out there. But nevertheless, it also could be a sign that people realize that the speed that they have to move to keep up with the AI revolution.
And sorry, Mark, do you mind just going into the what you called circular there? What do you mean by circular deals?
So in this case, basically, OpenAI have basically agreed to buy up to 10% of AMD shares. And they've got warrants as well. And so effectively, they're going to give AMD money for their 10% stake. In return, OpenAI are going to guarantee to buy computer chips off of AMD, AI computer chips off of AMD. So effectively, OpenAI are funding AMD to build the chips, and then they're buying them anyway.
Which is exactly what we saw with NVIDIA already, wasn't it?
But I think it also is indicative of the fact that there's a real shortage of high-powered computing chips that are sort of to be used in AI applications. And that's why people are trying to secure supply in the long term. And it will be at the expense of companies in the UK, Europe, and even places like China. And the Americans are all over this, trying to make sure they can get as many chips as they want, or they anticipate they want, over the next 5 to 10 years. It's a huge market.
The thing that worries me there, obviously, is OpenAI now has $1 trillion of commitments that it's made, and it doesn't have cash. So, it's loss-making. It doesn't have the cash, so it's going to rely on...
Rich, what? You're such a wet blanket on this stuff, mate, aren't you? You're such a wet blanket. Just believe!
Next bull story, please. Let's go on.
Do you realise, during the internet bubble, the companies found it hardest when they actually started making money. The ones that went up the most were the ones that didn't make any money. Of course, because when you start making money, you can put a proper valuation on the company rather than theorise about it. And, maybe we're seeing a bit of that now. Now, ChatGPT, which is part of OpenAI, already has subscriber revenue, and that will increase and increase as it grows. And as you remember, a few weeks ago, Google, they were being investigated for having a monopoly in search engines, and that was thrown out because there is this growth in other search engines like ChatGPT, like Perplexity, like many of the others that are coming.
I think, just being, just joining you a little bit in the grizzly camp, just for a second.
Come over, it's fun here.
It is interesting how everyone is becoming so incestuous by linking their companies up together. I read a very interesting article on that this week, which basically said there's nothing inherently wrong with that. I mean, the Japanese did it for many years with their with each having cross-shareholdings in companies, and that's how Japanese industry did work before it all went wrong. And the problem is, what happens when it goes wrong is everybody goes wrong together. So if they go up together, they will all go down together because they've had all these relationships with each other, which they're locked into. So it's fine while the music's playing, as we've said before. We just got to be very careful, watch for those signs, but no signs at the moment. But it's just, we've seen this film before.
It applies to lots of different areas, not just AI. I mean, this week, I know Chris and I were talking about it before the program about a company called First Brands, which is a major private company in the US that is unquoted, so you can't invest in it. Well, thankfully, we couldn't invest in it. But they're an auto car part maker, manufacturer and distributor. And they've gone into what's called Chapter 11 or bankruptcy in the US with debts of around $11.6 billion. And the fallout from that is some of the banks who have lent them money are going to have to take losses on that. So Union Bank of Switzerland, the UBS, are going to have a hit of about $500 million. And Jefferies, which is a large investment bank in America, is going to take a hit of over $700 million. So, when companies go bust, there are many other people who get affected, not just the companies that are supplying into them, because it also can have a big negative impact for them too. Elsewhere, Trump has infuriated a few people because he's talking remember the government shutdown has led to a lot of workers, up to 750, 800,000 workers who are working for government in non-essential areas to be furloughed. And we remember furlough from the COVID days. But he's saying that the furloughed workers in America may not be entitled to get back pay, which would be completely a break with tradition. Now, that could have quite a negative impact in the short term, depending on how long the shutdown goes on for, on the real economy of the US. So we've got to keep an eye on that very closely. But it's something he's thrown up in the air, but it's maybe just typical Trump, where he's throwing out there for effect.
The art of the deal.
Indeed. Now, talking of other things, last thing in America really is that the Federal Reserve's had their minutes from their monthly meeting in September out last night. There was nothing new in there apart from it's maybe a little bit more hawkish than someone like as a Dove, who I believe. Hawkish, which means that people who want interest rates to go up and anti-inflation, and Doves like me who want interest rates to go down because I'm not worried about inflation, I'm more worried about growth. And so the inflation, the hawks, the people who thought inflation needs to be a bit more controlled, sort of had probably more of a say than we thought they had after the press conference last week when they cut interest, or a couple of weeks ago when they cut interest rates. Again, something to keep an eye on. And the US bond market moved a tiny little bit and reduced the chances of a cut, another 25 basis points or 0.25% at their next meeting on the 29th of October, down to 92% probability from 99. So it's neither here nor there, but at the edge it was something. One thing I want to talk about is very quickly is because of the shutdown, there is a lack of data going in that analysts and investors can get hold of. We have the start of the US and the corporate reporting season start again next week with the big banks, JP Morgan, Goldman Sachs, Merrill Lynch, and Citigroup, etc. They will start next week. And then a couple of weeks after that come the beginning of the Magnificent Seven with people like Google and Amazon and so on. And we have to be very cognizant and watch those carefully because that may be the only hints we get of how the underlying economy is really going in the US and the world.
Yeah, as if the Mag 7's attached to the real economy. Come on, please. Anything this week from you, CJ?
Just one thing, really, but I just wanted to just come in on what Mark said there, where he gave us hawks a bad name because he said us hawks are looking for rate rises. We're not looking for rate rises. We're just not looking for them to be cut as aggressively as the market's discounting.
Please do the honors.
Yeah. So to me,
no 5 rate cuts from you.
So to me, I think it is best to point out to our listeners, hawks are people who think that rates won't come down as quickly or may go up. The doves will be people who think they should be cutting rates now and driving it down more. So I just wanted to put that little bit of differentiation in there before we get a bad name. Number one. Secondly, the one thing that I thought was interesting, and this is just me putting 3 and 3 together, making 27, is an announcement in the UK by AstraZeneca, where they made a very interesting change last week. They decided that in this battle about where they want to get listed and, this big battle between New York and London, that they were going to keep their joint listing. Well, wow, so what? But what they were going to do is they were going to go for a full listing in America on the New York Stock Exchange. From there, what they have now, which are these American depository receipts. Mark talked about those a couple of weeks ago, but they're a way of trading international companies on US exchanges, which isn't going for a full listing. By going for a full listing, the shares have to be traded in New York on the deposit with the Depository Trust Company acting as custodians. Right. And therefore, they're essentially switching things from the shares in London to being shares in New York. And in the UK, you'll be trading depository interests. Now, people listening to this, if they haven't fallen asleep already, are starting to wonder why not. The reason this is important is because trading in depository interests or trading in New York does not attract stamp duty. And the calculation is that this change will cost the Exchequer over £200 million. Now, if we think they've done that, what's to stop BP, Shell, other big companies which currently have ADRs in America doing the same thing, make it cheaper for everybody to buy their shares? And so what you could have here is a way of getting round stamp duty by companies, which will cost the Exchequer in the UK, I think the amount that stamp duty raises is somewhere between £3 and £4 billion. This will be really interesting to see what Rachel Reeves does to this, whether she, A, says you can't do that and changes the law, which is clearly possible, slap some tax on depository interests, or she does the sensible thing and stands up and says, I'm going to get rid of stamp duty, which immediately would be a good fillip in the arm for the UK stock market. Something to watch, not something I think will necessarily happen, but just very interesting what's going on here.
Right. Now, I think, Mr. Chairman, you gave us some homework last week after the quarterly review. What should we be looking at?
Last week, we reviewed the entire portfolio in our quarterly review. But as I said last week, with all asset allocation meetings, people in the city love to drone on for hours and hours. And in the end, we get to a situation where we didn't actually reach consensus and a conclusion. So that's what I wanted us to do today. And boy, do we need to, given how our weekly portfolio has performed. Now,
let's get that up on screen.
Yeah, so let's put that up on the screen now for those who are looking at the YouTube rather than who are listening. And you'll see it's been an absolutely fantastic weekly performance. Up 2.6% on the week, and our total return of the portfolio since inception over 8%, 8.2%. You can't keep a good man down. The VanEck crypto and blockchain innovators is now up 50% since we bought it. I'll repeat that. It's now up 50% since we bought it.
8 weeks ago.
And that's 8 weeks ago.
Good job we didn't sell it a couple of weeks ago.
That has been our best performance. And cash is clearly our worst performance, but even that ekes out the return that cash gets. So it's been a fantastic week. And I think combined with the quarterly review will lead us to have to think about what we want to do. Before we get to what we want to do, I did say that this week we would have a deep dive into the emerging market space. And I arranged for two experts to come and talk about it. Just hold on. I've got my phones ringing. Hello. Oh, right. Okay, I couldn't find any experts. So actually, I've now got Rich and Spicy who are going to talk to us about the emerging market asset class. Now, of course, clearly I'm joking. They're very well respected in this area. They both know a lot about it, a lot more than I do. So I'm going to take on Rich's role as coordinating the pod just for this segment to talk about emerging markets.
Good luck.
Thank you. I'll just have the cards as well. Mark, maybe you might like to start and guys, just give everybody a flavour for what do we talk about when we talk about emerging markets? What are the markets that are there? What are the drivers? And what's the attraction of this as an asset class?
Sure. Well, it's a huge sort of area to cover, including lots of different countries. If you imagine all the countries outside of the main European, US and UK stock markets and some of the Asian markets like Japan and some of the other markets around the world. Basically, to keep this simple, we're going to focus in on what is the iShares Core MSCI Emerging Markets Investable Market Index ETF. It sounds a very long, convoluted sort of name for an ETF, but it's one that we can have data on, and it's also one you could put in your pension or your SIP or your ISAs, and it's the biggest in the world. It happens to be valued at about £22 billion worth of assets in there.
Can I ask let's have a little bit more detail on that, just in terms of what that stands for. iShares is the firm who are issuing the ETF. What was the next thing? MSCI?
Core MSCI Emerging Markets Investable Market Index.
So the MSCI is an index provider, just like you've got the S&P, you've got the FTSE. MSCI do indices for around the world. This is an ETF that's linked to the index. And the last part of it was?
The Investable Market Index, ETF. By saying investable, we're taking out Russia. And because Russia is deemed by most investors, including ourselves, to be uninvestable because of the war on Ukraine.
Thank you.
Whereas
You're
historically,
quite good at this, aren't you?
I'm trying to show you the way to go, Rich.
well, I mean, Russia was part of the index until 2022. Obviously, when they invaded Ukraine, it was taken out, and they were approximately about 3% of the overall index. And if they were there today in the same index, if they were included today, that would have fallen to about 1.5% to 2% because their stock market, the Russian stock market, has been falling very, very heavily, and the currency has been very weak as well. But the biggest companies now within the index, I'm going to go through the top 5 now, is China is about a quarter of it, 25% or so. Taiwan is about 19%. India is just over 15%. South Korea is about 11%. And then Brazil is about 5%. Those are the top 5 weightings by country in this ETF. Those top 5 account for 75% of the whole ETF. Now, if you looked at it sector-wise, no surprise that information technology, anything to do with AI has been doing very well. And that's about a quarter of the entire fund if you took it in each sector from each country. So about 25% is information technology. Financial services like banks, insurance companies are about 21%. Consumer discretionary and is about 13%. Communication services about 10%. And then industrial is about 8%. So they're big chunks of the market in those sort of sectors. And that gives you a very brief and quick overview of where we are.
Can I ask a question there? If I was to look at the geographical split of those sectors, would it look like the overall index, i.e. mostly China, then was it India and then down? Or is there any place in particular who's really good at IT?
The reason that Taiwan and Korea appear in those top names is because Taiwan Semiconductor is the biggest company in Taiwan. It also is the biggest company within this ETF. It's about 7% of the whole ETF.
Oh, right. So that's one of the things one needs to understand when looking at this is that 7% of the whole ETF is probably your exposure to Taiwan, which is Taiwan Semiconductor.
Exactly,
okay, thank
exactly.
you.
And the second biggest holding is Samsung Electronics. Many of you will have Samsung products around your house, maybe the television, whatever it happens to be, sort of fridges, etc. And they are, the leading manufacturer of smartphones. They make memory chips and mostly consumer electronics, which is why people learn. But they're Korea's biggest company. And in this ETF, they're about 5.3% of the ETF. So those two companies alone make up the top 2 holdings, about 12% of total, nearly 12-13% of the ETF itself, and basically those make up the big weightings from those countries, Taiwan and Korea. The next biggest is then Tencent, which is a Chinese technological conglomerate, and they're about 4% of the fund. Then Alibaba, another big Chinese company, a bit like Amazon in China. Alibaba's just under 4% as well.
So when I look at this, just as with a sort of non-expert view, I need to think that the IT areas are going to do pretty well if I want to buy into this sort of trust, because the way it's set up, the biggest companies in these emerging markets are those AI companies, are those information technology companies. And so if we looked at it, just contrasting it again to the UK, let's say, where we've got very few of these, this is a mirror image of exactly the opposite sort of thing of what we've got in the UK. That's what you're saying to people.
Absolutely. Like I say, about a quarter of the ETF is in information technologies. Now, if you compared it to the S&P 500, about 35% of the S&P 500, so about a third of that is actually IT and sort of the Magnificent Seven as they've become to known. So it's got less than it has in the S&P, less of a skew, but it's still very significant nevertheless.
But if I'm correct here, and I think I am, emerging markets overall, their performance has been pretty poor over the last 5 years, let's say. Very good performance this year, but before then, pretty poor performance. Does that mean their IT companies are very cheap, actually, compared to how they trade in the US? So therefore, if they were trading on the same sort of multiples, this could do very well.
I think that takes us to a kind of wider description of what emerging markets is. So I was head of emerging markets at Credit Suisse in their equities EMEA division. So that's Europe, Middle East, and Africa. So I had the great fortune of looking after South Africa, which we'll talk a little bit about today, Turkey, and Russia. Now, you can tell there a lot more instability, right? Depending on how their presidents are. And we have seen Russia. Russia always traded cheap. It was always so tempting to buy the Russian banks because relative to US banks, you were getting them at 4 times earnings, right? In fact, you could buy the whole Russian index at 5 times earnings. That is relative to the S&P at 20.
Yep.
So yes is the answer to your question. They do always trade cheaper, and the Chinese internet stocks, have been tempting. In fact, they've had a great performance this year. But it's the question, people got burnt by Russia, right? All the big funds that were invested lost a huge amount of money. And the question is, do they want to make the same mistake by going into China? Now, front page of the Sunday Times this week was all about China and the spy ring in the UK. If China were to invade Taiwan at some point, as President Xi has alluded to, then you'd get your fingers burnt again. And this is just the constant risk. By investing in emerging markets, you're buying something that's cheap and it's volatile, but knowing those little intricacies is the important part.
What we're saying is there's some great value companies here, but there's a degree of political risk surrounding most of the regions. And it's how you discount that in. And the way the market discounts that in is to keep things trading quite cheap, to say, well, yeah, it could go wrong. China could go and invade Taiwan, in which case you've got a problem with 7% of your portfolio, perhaps. And so, therefore, the cheapness is the political risk premium being built in. Okay, all right.
So if you looked at the PE ratio, the price earnings ratio that we've talked about before in earlier episodes of the emerging markets index, it's only about 16 times for this year. Now that compares with the S&P 500 at the moment at about 23, 24 times, depending on if you want to be a bear or a bit more optimistic like me. But either way, there's a big discount. And that goes back to what Rich is just saying and you explaining that there is this political risk. And there is also some mistrust about some of the numbers of the way companies report in some of these businesses as well. Western investors don't necessarily believe that some of the numbers are there. So they automatically discount it. They want to believe it, but don't quite sort of wholeheartedly back it up. Now, this index has already outperformed substantially this year.
Done very well this year, certainly.
About 27% this year. But it's still a long way below its all-time high historically, which is back in January 2018. So there's been a discount for there. My instinct is that if we're right and some of the money starts to flow out of some of the biggest names in the US, etc., and money goes elsewhere in the world and the global economies start picking up, then this index should start to move back to its all-time high, which gives us plenty of headroom if we were to invest in it today. We're not buying it right at the very top. We're buying it at a quite big discount to where it is traded historically.
You say 2018 was the peak.
Yeah.
What are the couple of reasons why it's done so badly in that first period? Now it's doing better. It's coming back up. But what are the reasons for everybody as to why that is the case? A lot of that's going to be to do with China, I'm presuming.
Yes, yeah.
And the fact that people can't predict what's going to happen there next. And we've gone from a love-in by most people in China, take David Cameron and George Osborne, who were trying to do many, many deals with China, to now everybody hates them. So presumably that's something in there.
Definitely.
But what else has been in there?
China's the big one. Obviously, Russia was part of the index at that time.
Yes.
There was a big chunk of it. That's disappeared completely,
Yep, so
taken out of the index.
Yep.
That's gone completely. Then you've had some countries like South America. Like Brazil was particularly a lot bigger back then. And places like Mexico were bigger parts of it, and they're now very small portions of part. Now that's been compensated for now by countries like Saudi Arabia's come in, because Saudi Arabia is home to the biggest company in the entire world, if you were to do it a full market capitalization. It's called Saudi Aramco. It's their oil company and backs all their oil companies. It's huge. It's absolutely enormous. And it's the only really big sort of non-US company in the sort of top 10 in the world. If you were to look at the biggest sort of companies from emerging markets in the world, Saudi Aramco, which is their oil company of Saudi Arabia, is the 7th biggest company by market capitalization in the world.
Right.
And that's behind Nvidia, Microsoft, Apple, Amazon, and Meta. And so it's huge, right? It's about $1.5 trillion worth of market capitalization. However, there's only about 2% of the company is floated on the stock exchange. If you were to take the full valuation of Saudi Aramco, it would probably be worth $75 trillion.
Wow.
So you can see that it would far outstrip the size of any big company. Nvidia is currently about $4.5 trillion, the biggest company in the world.
Yeah, I've got a long way to go, these Americans.
Exactly.
Long way to go.
Exactly. Now, interestingly, Taiwan Semiconductor, which obviously we've already touched on Taiwan, is valued at about $1.2 trillion and sits around number 9 or number 10 in the biggest companies in the world. And it's a great company, but it does have this inherent political risk that if one day China were to turn around and invade Taiwan, that could halve. Quite literally half, which is interesting. One of the reasons, and the company as a whole are investing in America, manufacturing in America and other parts of the world to reduce their dependence on being in Taiwan should that ever come to pass.
Grow your portfolio with IG. Invest £50 with IG and get a free share bundle worth between £40 and £200. Make your first investment into an ISA, general investment account, or SIP by the 31st of October and benefit from commission-free investing, as well as 4% variable interest on your cash. Other fees may apply. Terms and conditions found in the show notes or on ig.com/UK. Kickstart your investing journey with IG today. One of the other main things, and since 2018 as well, you've got to take currencies into consideration when you come into emerging markets, because of course you're dealing with emerging currencies. Now, to give you a feel of how important that is, the Turkish lira has depreciated by 80% in the last 5 years. Right? Now, that's great if you are in dollars and you're earning in dollars and then taking the profits back to Turkey. But if you're raising debt as the Turkish government in dollars, then your debt is getting a whole lot more expensive in the local currency terms. So when the dollar's been strong, as it has done since 2018 until a few months ago, so the start of this year, they got whacked by COVID because, COVID was a big struggle in a lot of these countries. Then they got whacked by interest rates going up. And then they got whacked by the strong dollar. So there's been that huge underperformance. And only now things are starting to turn because of the weakening
dollar and the other things. And they can cut rates a little bit and they can drive. All right, okay, understood. If I was to think about that political risk you were talking about, let's go a little bit further just into that. How do you regard China in terms of investability? What sort of risk do you think is there? And I suppose my final question on that would be, can you buy the emerging markets without China? Buy an index without China. What are the thoughts on that, guys?
Let's cover the pros for China. It's the second biggest population in the world. They are currently trying to stimulate their economy because they're trying to offset deflation, which is falling prices rather than rising prices, which is inflation. They are the world's second biggest economy. You can't get away from it. And they've got 1.4 billion people, huge middle classes expanding, lots of very good companies, albeit rated very lowly. And one of the reasons that they are rated lower than other countries is because the government have what's called the state-owned enterprises. So the state own between 40 and 50% of many of their biggest companies. They have an interest in that, which means that they're not as efficient, perhaps, as a pure externally 100% owned by shareholders company like there would be in America or even in the UK. So they have slightly different sort of objectives as companies. Sometimes it's to pay back government debt rather than give the money back to shareholders or pay down company debt, so government debt, rather than invest in the business for the future. And so this interest of this big state-owned enterprise shareholding, that is between 40 and 50% of all Chinese companies, is actually very significant and will keep a lower rating on it. That doesn't mean that, the valuation, they might be trading on about 12 times price earnings ratio. Doesn't stop them going to 15 or 16 times, but they're probably never going to go to 23 or 24 times like we have in America at the moment.
Just to push you there on CJ's question, would you want to be invested in emerging markets ex-China or emerging markets with China?
Personally, with China. And that's because I think they're in this stimulative mode at the moment. They really want to try and get their economy going. And I'm a believer that economic growth across the world will begin to pick up. It'll be led by America with the, One Big Beautiful Bill and all the rest that we've talked about many times. But in the next 12, 18 months, I believe the US growth will pick up. That'll lead to better growth elsewhere in the world. And China, as one of the big manufacturing hubs of the world, and they will be a major beneficiary of global growth picking up. And we haven't had that at the moment. So, as an investor, you've got to anticipate what's coming because the current share price has already discounted what's happened in the past. You've got to look forward. It's not going to be perfect. Your timing may be a bit off, but you've got to be positioned for maybe some of these things as you see the world. And I see it as an improving global economic outlook. China will be very much a beneficiary of that. Because the world's
but you have that one risk on the horizon that China does something with Taiwan and then essentially becomes an outcast. And then there's a whole chunk of the portfolio there. So the Chinese have been the most sensible strategic mindset of any group of people over the last 20 years. And you've seen with their initiatives to get exposure to parts of Africa and Asia, that they're thinking a long way ahead, and with their rare earths as well. So I think they can take on America with their economic might. I don't think they need the military side. So I suppose if you're wanting to put some of this in your portfolio, A, you need to understand that there's a big risk there. So B, you want to make sure it's not too much of your portfolio, I suppose, would be what you're saying, Mark. Am I putting words in your mouth, or is that what you're thinking?
No, I wouldn't, mortgage the house and put it all in emerging markets. No doubt about that. If instinctively you want it to be, 5 or 10% of your portfolio, probably at most. And that's because, as you say, there are these inherent risks. But remember, China is only about a quarter of the whole emerging markets index.
Yeah, well, so we've got 5% in India at the moment. That is our emerging markets exposure. Take us through India.
So we talked about India a bit last week. The big reason for being in India is that there is a huge demographic change going on in India. They are the biggest population in the world now. They overtook the Chinese population back in 2023. Their population growth is expected to keep growing until about 2050. So for the next sort of 25 years or so, whereas China's population is now beginning to decline. And within that growth of population, there is a growing middle and upper middle class of people who earn, a very decent amount of money for the country they live in. By our standards, is very poor, but basically incomes are basically going. That's for people earning between £4,000 a year up to about £42,000 a year. That's what the middle class is. Now, a lot of that middle class are young, under 35. They're really keen to invest in stock markets and save. They save at about twice the rate that we do in the UK, and they basically want to keep investing in their own stock markets. So 75 to 80% of all the shares owned in India, in the Indian stock markets, are owned by domestic Indian people.
Wow.
And that's huge. Now, that middle class and the upper middle class is currently 29% combined of the population at the moment. But by 2050, in 25 years' time, that's going to be over 50%. So it's going to be doubling effectively. And these are all increasingly wealthy people who want to invest in the stock market, and they're happy to do it. They're very price insensitive. They don't really care about the valuation. And there's an old saying in stock markets, valuations don't matter until they matter. And that means that no one really cares about the valuation until things go wrong. And then everyone looks back and goes, oh, look, it's too high. And I always told you it was too high. That will be a rich quote, I'm sure.
I'm going to get a hat with it printed on.
So no, I mean, look, as a nation, they're savers. They love their stock market, and they're going to do it. It's expensive, but the biggest companies in India are not very big tech companies. So the biggest company is a bank, actually. And that's about 14% of the Indian index, and it would be a big chunk of the ETF. And there's 3 banks I can see in the top sort of 5 holdings, and then there are more consumers and oil companies, and a very different makeup of an index. So it gives you some diversification in the Indian index to things that with the big growth drivers seeing in other areas. And probably that's one of the reasons the Indian stock market has performed not as well as some of the others so far this year. But nevertheless, that's also been because Trump's tariffs. And remember, he slapped effectively a 50% tariff on India because they were buying oil off of Russia. And he basically added another 25% to an already 25% tariff. Now, one day, that will be, we know Trump, he'll probably turn around at some point and say, right, I'm changing that back to 25%. The Indian stock market will absolutely roof it at the time. So I think as a counter, it's a nice sort of sleeper to have in your portfolio.
Think so. Yeah. Right, just to take us very quickly through South Africa then. So South Africa, I lived down there. I was so excited about the prospects back in 2012-13. And of course, huge mining community down there. So there's a lot of exposure in the index to gold miners. That makes up 10% of the South African top 40. However, if we were going to buy the ETF, we're not really getting South African exposure. We're getting companies that are listed elsewhere in the world are also listed in South Africa. So to take you through 4 of the top 5 companies, you've got Anheuser-Busch InBev, because they bought South African breweries. You've got BHP. You've got Richemont, which is, of course, the fancy watches. And then you've got British American Tobacco. So, you've got a European listed company, a Swiss listed company, and then 2 FTSE listed companies. So South Africa's got great prospects because if you look at the interest rates, they're 7% a year, and the currency's only lost 5% in the last 5 years. Compare that with Turkey, which has lost 80% of its currency. Then you've got a nice rand appreciation story. However, investing in the equities doesn't really make sense because you're just investing in stuff from other countries.
I mean, the good thing is it's only 3.3% of this ETF that we're looking at. And actually, the biggest holding in this particular ETF is Naspers, which you remember is their global internet and sort of technology company. They invest around the world. That's a third of that whole sort of 3.3%.
And they own Tencent. Yeah. So that's...
So, I mean, you're not exposed to sort of double counting by having some of those mining companies, which we would have, in the BlackRock World Mining Fund.
So, in conclusion, I think what we're saying is, got some very attractively priced companies. You need to be able to take the political risk. You need to be able to be comfortable back in your mind. And one of the main factors driving what your return will be a weaker dollar as much as anything else. Absolutely. Am I right? Is that my right cheat sheet for when I think about things later?
Yeah.
Okay.
Spot on.
Thank you very much. Okay, so let's move on then. I'm going to hand back the role of coordinating the meeting to Rich, but let's carry on with where we were with regard to the quarterly review and what we need to do on the portfolio. What we said last week was that asset classes are all looking pretty good, and we could have bought more things last week, but I think that we've got to be realistic. We've got to think about where prices are and some of the risks that are around. And I want to draw attention to 2 things before I hand over to my 2 colleagues here. We talked in one of the earlier pods that you want to look for turning points in markets. And, those turning points in markets are often things you see after the event, but if you can see them at the time, it's just helpful to put you on watch. And we talked about that time in 2007, where Chuck Prince, who was CEO of Citibank, said, when the music stops, in terms of liquidity, things will be complicated. But as long as the music is playing, you've got to get up and dance. And we are still dancing. And within days, that was the top of the credit market and starting the long road to the global financial crisis. So when I look at things, there are 2 things I saw this week which make me go, I wonder.
Oh, hello. Tell me more.
The first one was the headline in the FT on Tuesday morning. Now, why do I mention headlines? There's an old saying in the markets which says that when something appears on the front page of a newspaper or maybe the Economist magazine or something like that, it's in the price. It's in the market. The last person in, it's ready to turn tail and move in the other direction. What did we see on the front page of the FT? Gold-plated FOMO powers bullion record-breaking rally. So front page of the FT feels it's fine to talk about gold having gone from, 3,000 at the start of the year to now 4,000 and going strongly. It suddenly gets put on the front page and referred to as a FOMO rally, which for everybody wanting to understand what it is, fear of missing out.
But the very fact that Financial Times, they shouldn't have words like FOMO on the front page.
And so that concerned me when I saw that. I thought, is this a sign? Maybe, maybe not, but something to think about, number one. The second one Mark talked about earlier, which I thought was really interesting this week, and that's this First Brands in the USA. Companies selling car parts in Ohio in the US. It's gone bankrupt. And Jefferies Credit Funds reported exposure of $715 million. And UBS, as Mark talked about earlier, is saying they're going to lose over $500 million. Now, this is private equity. And, you'll need to get ready with your yellow and red cards because if I'm not careful, I'll start ranting and you'll need to stop me. But I have a big problem with private equity and private debt. And we'll do an episode at some stage in the future to talk about these things in more detail. Essentially, the institutions within the investing framework, that's pension funds and insurance companies, have been searching for yield and searching for yield. And in an environment where interest rates have gone from 5 to 0, and there's been lots of QE done, they've been searching for yield, and along come these clever people who say, I tell you what we'll do, we'll put together a private debt and a private equity fund, and we can offer you massive returns of 10, 11, 12% a year. And what's happened is you've formed these huge number of private equity, private debt, hedge fund type concerns who are basically doing the banking industry's job for them. The banks aren't lending money to these people anymore. It's being lent by these hedge funds. And of course, what hedge funds do is they leverage things and they take big exposures. And there's no regulation on this at all. None whatsoever.
What are the names of some of those funds? Is it Apollo? Is that one?
People within the industry, Blackstone, Apollo are two famous ones, but there are a number of firms, and we can, in a later pod, we can list them all. Clearly, they won't be on my birthday card list or Christmas present list. To me, this is something people need to be really aware of. We've seen investment industry going into these illiquid investments to try to pick up yield, which when the world's fine are absolutely great and not a problem. Not having to go at them in that sense. But people have forgotten the role that falling interest rates have played in making those returns so good in the past. Interest rates have now risen, and now these things are suffering. And so the thing that I think about with this is this the sign that some of this slowdown that Mark's been talking about in the US is starting to come through in some of these traditional industries, and all the debt problems are not with the banks. They're with these private debt groups. And so we've got to be very careful that we're watching this. So here are two signs to me of excess that's happened, and maybe we're getting closer to a turning point. So this gives me concerns as to where we are in the cycle. And there's here's another saying which we're going to bastardize indeed with where we are in the world today. Are these canaries in the gold mine?
Yeah, very good.
Very good.
My conclusion is I see signs of excess. I see worries. I am a worried person. I naturally worry because I'm a Bond guy, as Spice would say. I don't think we're at the top yet. I still think there's more to go. There's more exponential moves in some markets. We've seen some exponential moves already, but there are some still to go. So I want to add in things that I think are looking still cheap. And to me, after our conversation last week, I want to add to the World Mining Trust. I like that. I like the outlook for the metals. I like what you guys were saying last week. And I like what you're saying about emerging markets as well. So I would add exposure there. What I would do, though, is looking how well the VanEck Crypto and Blockchain Innovators ETF has done. Having sat on my hands for the last 2 or 3 weeks, I would now reduce our holding back down to 2.5%. So that's where I am from what we heard last week, what we've heard this week. Rich, where are you?
Well, looking at the portfolio as a whole, right? That number at the top, let's not ignore that. We are up 8.2% in 8 weeks. That doesn't happen, right? We've all been in funds, and that is astronomical, far beyond what we could ever have dreamed of. Now, our target, let's not forget, is 10% for the whole year. And we're 2 months through the year and we've got 8%. We could put the whole amount in cash now, and uninvested cash with IG pays 4%.
It'd be a very boring podcast.
So
if we did.
doesn't mean it's the wrong decision.
No.
And that would mean we'd hit the target. Now, just reminds me of a story at Brevin, actually. In 2007, we had an Australian PM who shall remain nameless, and he made a fortune on a stock called Linus. Now, Linus is an Australian rare earth miner.
Oh, right.
Oh, I think might have heard of some of those recently as well. Yeah. It was up 117%, and he had a big part of his portfolio in it, along with others as well. He made a huge amount by the August of 2007, shut up shop, and went on holiday for 3 months because he knew he was going to get paid very well. He did get paid very well, but he didn't have a job when he came back for 2008. Because it did not go down well with the bosses. So yes, I agree. Going 100% into cash, even though that would leave us up 11% for the year, is not an option. However, what do you do in that position, Mr. Chairman? Do you increase the target for the year?
Well, it's a very, very interesting subject. And, we were thinking about how we might tackle this subject in one of the future podcasts. Because I think, to be honest, it's more worthy than a quick 5-minute conversation here. I think it's, how do you react when you are ahead of where you think you should be? Equally, how do you react when you're behind where you should be? If we were down -8, what would you do? Would you triple the positions and go over borrow to try to get there or not? It's a really good debate. I have a lot of sympathy with what you're saying. Our number one task is to get to 10. And so that needs to be in our mind. And so, we will tackle that subject going forward. I'm going to park that for today because I don't think we're at the top. I think there's more to go for, but I am getting nervous.
I don't think anybody ever can call the top like that, though. So it doesn't, I don't mind you saying, I don't think we're at the top, but it's irrelevant to me because I don't think anybody can actually call the top, especially the bull to my left.
Wait and see.
So if you're sitting on something that's up 51% and you're almost at your target for the year, then I'm sorry, I would sell all of that and I would go into the FTSE, which is far more defensive. So my homework is that I want to get my hard hat on and I want to come out of the expensive, volatile assets here because I think we've got a correction coming. I think that we've got a 6% move lower and I'm uncomfortable. Now, the things I'm comfortable in are gold, copper, the FTSE, India, Russell 2000 still, and the World Mining Trust, which I agree with you, I'm very happy to increase in. But that VanEck blockchain innovators for me would be gone and I would be cutting the S&P 500 exposure in half like we did with the NASDAQ before. So while I wouldn't be moving 100% to cash, I'd be moving the expensive S&P 500 into FTSE and I'd be happy to go with you into the World Mining Trust and a little bit into emerging as well because we've said it's a little bit more defensive. But I can feel the glaring eyes from the bull.
Okay, look, I'm going to start with something you might like to hear, is that if I am concerned about markets and the US markets in particular at the moment, it is that we are seeing this proliferation in circular or self-funding intercompany deals. That to me is a potential concern. Now that comes about for two reasons historically. Companies take over another company with their equities, with the value of their company, when they think the value of their company is very high. So they will use shares to buy another company rather than cash. And that sometimes is a warning sign that the people within the stock market, the people within those companies managing it, thinking their own share prices have got too high. Now, in this case, a lot of it is to do with the AI revolution that's going on. It may be this time and I'm not saying it's different this time. I'm not saying it's different this time.
We almost said it.
I believe that these companies, particularly the American ones, have worked out this is a massive race to get into the AI revolution, and they will get first mover advantage. And that's why they're willing to spend billions, hundreds of billions of dollars on it. So that's why I think they are prepared to do these circular self-funding intercompany deals. I get it. But that is my biggest concern. I can see it from both sides. I can see management saying our shares are expensive, let's use that as currency. And I can see it from the fact that people want to race to get AI done. But I think when you look at our portfolio as a whole, we have what's called a barbell already in our portfolio. So that on one side, we remember in the earlier episode, we talked about anti-fragile and fragile assets. Fragile assets are the things that move up and down with economic growth and are more volatile by their very nature, and equities are those. If you added up all of the fragile assets in our portfolio, and you would take the S&P, NASDAQ, Russell 2000, Nikkei, Japan's market, DAX, the German market, the FTSE 100, and India, those are all equities. If you added all those up, that's 55% of the portfolio. But on the other side, what we've described as anti-fragile, supposedly do better when times get tough and when stock markets wobble, we've got gold, we've got copper, we've got crypto, we've got BlackRock World Mining, we've got cash, and we've got short gilts. And together, they are 45% of the portfolio. So we are balanced already between this fragile and anti-fragile. That's what you call a barbell. There's nothing really in between, but you have got guns on both sides. Now, you could say the BlackRock World Mining should be an equity. Therefore, you would maybe make that 60% into fragile assets and just 40% in anti-fragile or defensive. So I'm quite happy with the overall balance of the portfolio as things stand at the moment. I'm a natural bull. I still think we've got further to go, but I do think that I have sympathy with outside of the US, then we should be able to make more money by a sort of revaluation of some of these other areas. Emerging markets we've talked about today, I would very happily start there with a 5% position. I'd very happily do that. And the BlackRock World Mining Trust, which we also own, I would add to that. And part of the reason is, if you believe that these deals that the US government are doing, buying stakes in other mining companies, they're not just doing it because they think those equities are cheap. Maybe they are. Maybe that's the US government saying, actually, mining equities are cheap.
Because we know we're going to keep doing it.
Yeah. But there are rumours abound that they may be doing hundreds more of these sort of deals. Now, if lots of these little mining companies get stakes taken them by US government, I bet you the US government isn't going to be the only one out there doing it. I bet you the Chinese will be thinking about it. I bet you other countries will start thinking about it. And so that should lift the underlying valuation of mining companies relative to other companies. And a lot of the mining companies sit on a discount to the underlying commodity prices that actually they're selling by day to day. So they're sitting on a discount already. That discount may close. I'm very happy to put another 5% in BlackRock World Mining.
So you see, this is the big difficulty of being a asset allocation committee and what normally happens in the city. Exactly what's going on here is what happens around many tables and meeting rooms in the city where people have got strong views in each direction. And, there's no right or wrong answer here. Only time will tell you what's right or wrong. And of course, we can't see the future, but we can only act on our experience. So if I look at those things together, Rich has said sell 5% S&P 500 into FTSE. Well, I'm not really interested in that. And let me tell you why I'm not interested in that. Because if the S&P goes down, the FTSE is going down. Everything has taught us in the world. Everything has always taught us. It may not do it over 3 months, but over the first few days, the first week, first 2 weeks, FTSE was slapped just as hard as the S&P 500. So I don't regard that as a particularly defensive mood. I regard that as still taking exposure in a softer way. But every time I've ever tried that as a fund manager, it's always been a disaster. Because what happens is the US guys all come in and buy the S&P, bottom fish in the S&P when they think it's right. They don't come and buy FTSE. And no one in the UK ever buys FTSE, we know anyway. So it doesn't help. So I'm going to dismiss that one for the moment because I think I don't argue against buying FTSE. If I was bullish of markets, I might buy FTSE because it's better value.
That's just a bit. If the catalyst is AI related, then FTSE is bulletproof.
Yeah, but if it's not AI related, then I'm not particularly sure that the markets are going to come back very much anyway. So The VanEck, I think, is an issue for us. There's no doubt about it, because it's a large part of our portfolio. It's gone up far more than we ever thought it would. And I'm suggesting we sell it. Not all of it. I'm suggesting we keep a bit. I think Mark's suggesting we keep a bit.
Yeah, I'd be happy to sell half of it, because I think what I said before, it's net, when we were talking about selling someone, it was 30% up. It's now 50% up.
All right, smart ass. I sat on my... No. I'm the chairman. I sat on my hands. I didn't do anything.
You did.
Don't give me that.
We'll take the VanEck blockchain down to 2.5% weighting.
Yep. And then it comes down to the other two. And I think we should add 5% to world mining. I think we all like the world mining. And I think we should build a 5% position in the emerging markets and sit there with those. So as chairman, the decision I'm going to make, given the conversation here, unless someone's going to throw something at me for doing it, is reducing VanEck, take it down to 2.5%, putting 5 extra in the world mining, putting 5 extra in the emerging market, and take the net 7.5 that's going in out of cash.
Would you describe that as increasing risk? The VanEck's very risky.
I would say net, you are increasing risk. But you're not increasing risk by how much the numbers would suggest, because as you have correctly stated, the VanEck is a much more volatile instrument, and you're actually moving exposure from the really hot part of the market, to areas that aren't quite so hot at the moment. They're not cold areas of the market. They're pretty warm.
Simmering nicely.
Simmering nice. Thank you very much. And so you'll be increasing risk, but by not as much as you think. I do accept, though, that we are trying to fine-tune things here, but I think we are skillful enough to be able to at least show some of our experience through and think about a better time to sell than now more of our risk assets.
When it's lower in a couple of weeks.
Well, if we have to sell when it's lower, then as we've talked about before, one of the great skills of a fund manager is to not remember too much about what they've said or where they've done it, because it's more important what goes on in the future than what's actually happened in the past. So I don't like selling things that are off the top or off the boil, but if we have to, that's what we will do.
So I promised you at the start, difficult decisions and difficult conversations had to be made, and there they were. Thank you, Spice, for that deep dive into China and India, and thank you, Chairman, for trying to take on my role. If you like what you've been listening to, then please give us a subscribe, give us a like, and tell all your family and friends about it. We very much look forward to seeing what markets bring us next week. Gentlemen, if the viewers want to get some questions into us, then where should they write to?
The Art of Investing at IG.com.
We'll see you next week.